All right, beautiful. So we're live on YouTube. So welcome into the YouTube community. If you're tuning in live or catching the replay, welcome. For my clients and those that are on my email list, we're hanging out in the Zoom room together. If you want to be a part of that, all you gotta do is join my email list. You want to reach out, fill out my contact form, or if you sign up for any one of my programs or coaching, anything to that nature, or do any sort of joint work with any of my partners, you're going to get included in those email outreach, so you know when I'm going live and having these sessions. This evening, I have some news to share before I dive into tonight's masterclass on combining the velocity strategy with the infinite banking strategy. So combining velocity banking, infinite banking coming together to accelerate your finances in the direction that you want to take it. These two strategies, when paired together, can not only help you accelerate debt, it also reduces risk. It can also help with creating more income. So it's really just taking all the tools available in the 21st century and all the different financial strategies that exist, and think of velocity and banking as the foundation of how money flows in and out of your economy, and how we can do that in a very efficient way, very simple way, and how it can be applied at really all income levels. Obviously, the more income you make, the more flexibility there is. Not only the more income you make, but the more cash flow you have at the end of the month, you create more options and more flexibility. These strategies can be done at lower income levels, where I've helped single moms making 40 to 60 grand a year implement the strategy, but without the banking part, the infinite banking side, that comes a little bit later on the tail end of the strategy. But the velocity banking strategy can absolutely be implemented at nearly all income levels, as long as there's positive cash flow and the math makes sense in terms of what we're trying to use the strategy for. Debt elimination, or are we leveraging for income, right? Investing to create more cash or create more income. Okay, so I have been dealing with something. So this is the news part I'm gonna share with you. Last week, was it? I went last, when did I go live? Let's see. So I hosted an emergency rally on July the 10th. So that was a couple weeks ago. This time's just flying. And I brought the whole entire community together, clients, friends, partners, business partners, to all pray for a client of mine by the name of Brenda, who was diagnosed with stage 4 cancer. And I had the opportunity of hanging out with Brenda a couple weeks prior to going live on YouTube. And the initiative was prayer for healing and recovery. And earlier this week, Wednesday, early in the morning, Brenda passed away. So this is my very first client in my 8 years being on YouTube, 8 years being in business, 8 years running a financial coaching practice where I work with people one-to-one and families. I've never had anyone pass away before that I was working with directly. I've had clients, family members, or others pass away, but this is the first. And so my emotions and just stress and learning and handling this information and how to move forward in terms of serving the heir. So Brenda had a daughter and 4 grandchildren, if I'm not mistaken. So this news isn't what I was praying for, yet being a man of God, being a man of faith, and as you know, for the most of the people here who are also believers, that there's victory in this either way. Whether Brenda lived and recovered, or whether Brenda graduated from this earth and now has moved on to heaven to be with the Father. That is a victory. That is a celebration. Still, as a human being, we feel all those emotions, and we mourn, and there's stress, and there's complications and things we just don't understand or may not have all the answers to, or we draw different conclusions. All those things. So I just share that with you. Again, this community is a family. My clients I consider an extension of my family. It was all hands on deck to support Brenda in those final days, final moments. It was literally the whole team coming together. Big shout out to Daniel Romberg and his team over at Nations First. That was critical in just supporting. And my wife and I driving up to go see her and to spend some time with her, pray over her, get the the right environment, the right mindset going into this. And so now I have the honor of serving her heir and her grandchildren for years and years to come, if they choose to obviously use me. So far that is the case, and we're educating on all the things Brenda did, which was it's fantastic. Let me tell you, fantastic story. I've documented it multiple times on my channel. This was a person that went from when we first met, had a negative cash flow, literally almost $4,000 a month. And then by 2025, going into 2026, we came out of that negative cash flow into a positive surplus of over $1,000 per month, with a massive amount of debt eliminated and an increase in net worth assets of wealth that she now passed on to her heir. So it's just a phenomenal experience and honor and privilege service that I had to work with her. That's now come to an end, but there's a new beginning where I now get to serve the daughter and the grandchildren as well. So I just wanted to share that with you all. This is my first. I understand it won't be my last. I've said it many times before on my YouTube channel. I'm young. I'm still young, 30 years old. When I first started this at 23 years old, putting life insurance policies on clients and coaching them, that, the reality is the chances of my clients outliving me are very low. In fact, I'm probably going to be here for much longer than the vast majority of my clients that are already in their 60s, 70s, late 50s. And just know that you have an extension, an additional professional relationship and support in the unforeseen event that you graduate Earth, that you can have myself, my team. It's all hands on deck for all the preliminary work, all the pregame work that we're doing, everything that we're doing on this channel to support you in your finances, to get you to the next level, ultimately leaving a legacy behind that truly matters, that's truly impactful, is something that I have the honor of doing if you would have me in your family. So with that being said, we're going to transition. Today we're going to be discussing a velocity banking and infinite banking case study. So I'm going to give you the full context. If you have any questions along the way, comments, feel free to drop it in the chat, whether you're on Zoom or if you're on YouTube tuning in. All right, let's begin. So here we have an individual starting with the four major numbers, making around $35,000 a month, expenses around $22,000, debt $8.3 million, with a positive cash flow of over $13,000. Technically, the cash flow is even higher than that, and I'll get into that in a minute. But being conservative, these are the numbers that have been provided to me so far. This person became a client back in 2020. They purchased a whole life policy with Guardian, and we designed it the classic, very popular 10/90 split design. It's also called a 90/10, so it's however you word it. But essentially what that means is however much money you're contributing to a whole life insurance contract, if you're doing a 10/90, 90/10 split design, that simply means that you're driving the majority of however much you're funding to the cash value living benefit part of the policy, and the minority of that money is going to premium, cost of insurance, whole life. And we do this design primarily for the living benefits, the upfront high early cash value accumulation, to be able to then leverage those dollars in two places at the same time and having money grow in two places at the same time with the same dollar. That's one of the primary concerns, primary factors, interests for the majority of people I work with. Again, of all different income levels. Death benefit is extremely important, and there's a way of solving for that by leveraging term or convertible term. But specifically focusing on the intention of what this person was solving for, they went with a funding amount of $200,000 per year. And I believe they have the ability to do this for 10 years, I believe. And as you can see, the max funding amount is $200,000 per year. Their premium is $20,000, which means that at minimum, they would have to pay in at least $20,000 per year. And if they want the ability to go up to $200,000, they need to contribute an extra $5,000 for a total of $25K. So what happens is on their anniversary date, which just passed, it's July 2026, so they're now entering year 7 of their policy, they get a bill on the anniversary date for just the $25K. And then throughout the year, specifically with this carrier, Guardian, they have the ability to add an additional $175,000. In fact, they can do a little bit more than that, but we're designing it for the $200,000. And they can add in that money whenever they want. In addition, if they don't fund up to $200,000 one year, there's something called a MEC limit, modified endowment contract, and this MEC limit will roll year by year for a certain period of time. I think Guardians, it's 7 years, like a 7-year window, where your MEC limit will begin to accumulate year by year, what rolls over. So if, say in year 1, they fund 200 grand, but in year 2, they only pay in 25,000, that means they had $175,000 of unused MEC space. And we go into year 3, say they put in 200 grand in year 3, they have, and let's say they have a surplus of money, 175K, they can add in addition. So it's like dumping in 375 grand. So we're going to talk about that in a minute because that's what's actually about to happen here. So policy started in July of 2020. It's now 2026. The current cash value when all the moves are done, where we are, according to the illustration, we're going to have 1.1 plus million dollars, so 1,115,000 or more of cash value this year. Again, we have this MEC space now unused of 685 grand. We have a loan of about 403,000. This is the exact number. So $403,727.81. with a $3 million death benefit. This was originally on a 59-year-old male at the time. Now we're 65. So let's get into the strategy, currently what they're working with. And to kind of give a little bit of a summary, from 2020 to 2026, they've been doing velocity banking, they've been accelerating debt. This is a real estate investor. The majority of their income comes from rental income from the property portfolio that they have and some other investments as well. There's some Social Security income there as well. And so they've paid off a ton of debt. They've accumulated a lot of debt. The 8.3 million that you see there of debt, the vast majority of that is mortgages on properties that's cash flowing. So it's not a huge concern. And they've been practicing infinite banking where they max fund the policy, borrow against it, do investments in real estate. Real estate pays back the policy plus the cash flow plus their income over time, and rinse and repeat. So they've done this quite a few times at this point. They have multiple credit lines, they have a good credit score, multiple tools at their disposal. Here is one thing that they're doing currently. This is already in the works. They have a property that's worth about 1.5 million, paid off. They're doing a cash out refinance for $850,000. The interest rate will be 6%. It's a 15-year note. The mortgage payment's going to be $7,172.78. So they're getting 850 grand of debt, tax-free, out of this property. And their plan is to pay off the policy loan for 403 grand. So pays that off immediately, pays it off immediately. And part of that 403,000 includes the interest. So this is the loan plus the interest on that policy. Now, since they are paying off this loan in advance, they're going to get a credit back for the interest. The way Guardian works specifically, when you take out a loan, Guardian charges you the loan interest up front for the entire year, assuming you keep that loan outstanding. And if you pay it off sooner, then you get a credit back or a refund, call it. So that's how that would work. So in this example, let's just say 403,000 was the loan, 403, and let's just times it by 5.76% was the loan rate. So $23,000. They've already paid that for 2026, their policy anniversary date. It's already been paid. So now when they go to pay it off, they're paying the 403, which, call it 22,000 or so, was interest. It's all being credited back to their cash value. So they're going to see a net increase of their cash value going forward into this new policy year. In addition, whatever's left over, the difference between 850 and 403, so we're guesstimating anywhere between 400 and 450K, all going into PUAs. So notice how the max funding amount is 200 grand, but since their MEC limit is 685,000, the policy started in 2020, there was some years where they did not pay in the full 200 grand. So now they're making up, doing a make-up contribution where they have 175 grand for 2026 PUA. So that means 2026 policy year. That year is fully funded. So 685 minus 175K. Boom, MEC limit would drop down to 510. And then we have this 400 to 450K. Let's say they dump in another 450. they would still have $60,000 of unused mech space. As long as we don't breach fund more than the mech limit in any given year, we're okay. So there's flexibility. Not every life insurance carrier is going to allow for this. So keep that in mind when you're talking to your agent, or if you're working with someone right now and you're trying to figure out what carrier to go with. What I have found to be extremely successful for anyone that's a real estate investor, anyone that has fluctuating income, your salary plus commission, or you do a ton of overtime, or you are a business owner, that when you're looking at a list of different carriers that you are considering working with for your whole life insurance policy, you might be looking at Mass Mutual, you might be looking at Lafayette, Guardian, Penn, Meritas. Certain carriers are going to be a little more restrictive as to what you can and can't do as it pertains to PUAs. And you need to know those details before you fund the policy. This client understood that. They knew that, okay, if I go with Guardian, I'm committing to only this $25,000 minimum with the ability to go all the way up to 200 grand. If I don't do that, I don't lose the ability to do that next year. There's other carriers where you have a limited window of, say, 1 year, maybe 2 year makeup contributions. And then there's a percentage that they'll allow you to make up of your unused mech space. So there's little nuances where with Guardian, you're not going to have that problem as long as the policy is structured accordingly to allow for these high PUA dump-ins above and beyond what we're normally scheduling for. So just keep that in mind. Just want to share that with you. And that's what is allowing this person to do, 400 grand to pay off the loan, 450 to just dump right into PUAs. If they do just 400, then the cash value will be 1.115 million. If they do more, then that number is going to be higher. All right, so this, we ran an illustration showing the loan being paid off and PUAs of 400 grand. That's what we showed. And the cash value on the guarantee column said 1.115,696,000. So that's what I'm showing. So the person can take that to the bank. They can say, all right, this is what I can expect. Now, let's go into what needs to be done. The reason why they're doing the whole cash out refinance in the first place is they owe about $500,000 to friends and family for some real estate acquisitions. This particular property in question, I believe, is like not performing as well, and the end game ultimately they're probably just going to sell that. But being able to take that equity out now before they do it to sort of wipe the board kind of clean in terms of their emergency reserve account here, cash value, restoring that back to zero, and then leveraging the same money again to pay off friends and family. Right? So one of the things that people get hooked up on, they mess themselves up, is when you get a lump sum of money, and let's say you have an existing asset where you owe money over here and you owe money over here. So you owe money in two different places. With 850K, here's what most people do. They have a lump sum of money and they'll pay debts directly. So in this example, take 850 grand minus 500K. So what are you left with? 350. So now you have 350K cash left. You paid off, say, 500 grand of debt directly to institutions, to friends and family, you name it, to save money on interest. Recapture all the payments you were making. Now you're left with $350. Now you take that $350 and you're saving it, or you're investing it. Maybe you spend it. So you save it, invest it, or you spend it. This is what most people do. And you're shooting yourself in the foot when you do that, especially if you have pre-existing assets. And even more especially if you have a high cash value life insurance policy, or if you're doing velocity banking and you have some sort of a line of credit. So notice how for the same dollars, we're going to do two things at the same time. Instead of this way, most people do, pay the $500K directly, have $350K left over. Now I can only pour $350K back into what? What? Pay off the loan or add more PUAs? You're limited. Versus, I'm just going to make one little tweak. Say, hey, instead of paying your debts directly, take that 850 grand, plop it into the policy. You restore your cash value to zero, add PUAs to the asset. The vast majority of that 850 grand is going to show up in cash value. All of it. The vast majority. Especially this policy is in year 6. So it's going to be at the break-even point once they do this move. More than likely. So now they've increased an existing asset by well over $400,000+. Now they're going to leverage the asset yet again. We have two options. We're going to go into that in a minute. And so they're going to leverage 500 grand, borrow out of the policy again. And now pay off the institutions, pay off the friends and family. Recapture the cash flow, pay yourself back the interest. Rather than losing, opportunity cost is what some will say, losing the ability to earn interest on money that was already going to leave your economy. We already know in this situation, and many of you in the similar situation at some level, you have to pay your debts in some way. You have an obligation. Before you settle that obligation, especially if you're doing infinite banking, you want to be looking through the lens of how can I make sure that I'm using every dollar in my economy at least more than once. That's the lens that we want to put on. So if I have 850 grand to work with, how do I make sure before it leaves my economy that I flow that through some kind of system where I can earn interest on that 850 grand, or I can increase the equity or the capital leverage that I have before I send that money out of my economy, because I have to spend it anyways. That's what this person understands. They have to pay this 500 grand anyways. Well, why not finance it through a banking system of your own creation? Pay everybody off, recapture the cash flow, recapture the interest, pay yourself back the interest at a much lower cost. Let's get into those two options now. So I'm going to delete this. Now that you understand the thinking there, I'm going to delete that. Here are the two options that are on the board. This is where velocity and infinite can come together. Option 1 is a pure infinite banking strategy where you borrow directly from the insurance carrier $500,000. They'll get a direct deposit of 500 grand right to their checking account within 2 to 3 business days. like that. Very fast. It's quite incredible. I've done this many times over the years with my policies as well. It still blows my mind how fast I can make a loan request and receive the money. The interest rate will be 5.76%. The crediting rate is most likely 6% with Guardian, so there's a little bit of a arbitrage there. And obviously, all of their cash value continues to earn interest. From there, all the debts they paid off, all the moves they did, cash flow that they have, they're estimating paying back the policy anywhere from 15 grand a month to 20 grand a month. This is as simple as it gets. You borrow money and then you set up a repayment plan where the person is now going to pay themselves back. I'm estimating if they did $15,000 payments of 500 grand, they'll probably have this thing killed within 35 months or less. If they do 20 grand, about 27 months or less is what I'm guesstimating. All right. So now here's how this would work looking at option 1 in terms of the interest. We do 500 grand times 5.76. That's $28,800 of interest that would be charged up front. Right? That means on the anniversary date, so July 2027, is when they'll get charged that amount, 28,800, and then you divide that out by 12. We're looking at roughly $2,400 of monthly interest. Now, if we set up $15,000 repayment, 15K, here's what it would look like then. So 500 grand, 1 month. Let's say they take 500 grand and then immediately make a payment for 15K. When you make a payment back to a policy loan, 100% of the payment goes to principal. So it reduces the balance down. Because remember, you already got charged the interest from this carrier specifically. Other carriers don't charge the interest up front. It's a daily accrual. Still technically works the same way. When you make a payment, 100% of your money goes to principal, and then on the anniversary date is when they charge you interest. This is a really cool way that a lot of people don't understand when they're running math comparisons, when they're comparing a policy loan rate versus borrowing from the bank. You can't run the same math when you're using calculators, because you have to make sure that the calculator is registering that every time you make a payment with a policy loan, 100% goes to principal. Most calculators don't do that. When you are illustrating a loan repayment on a debt, typically the interest that month would have gotten pulled from your total payment. This works for all debts, credit lines, mortgages, student loans. Every month you make a payment, some money goes to interest, some money goes to principal. That's not how it works with life insurance policy loans. When you make a payment, 100% to principal. So now you have to run the math each and every month and say, okay, well, 485 grand times 5.76% divided by 12 is $2,328. So what just happened? I went from 2,400 minus 2,328. I just saved $72 of interest. So I won't get charged 28 there's going to be a credit. I'm going to get a refund on the anniversary date. And that obviously that number will go down further and further each and every month. So if say the average reduction each month goes down by $72 times, 12, I'm saving maybe $1,000 or so of interest in that first year. Okay, it's going to be more than that. So keeping that in mind, it's going to be way more than that. We can see how, all right, that's pretty simple, straightforward. Make a payment, $15,000, 100% interest. There you go, said and done. That they charge you at a bank. So now there's a little bit of an opportunity here where if the rate, now I'm making it neck and neck, so I'm just going to use 5.75%, get the line of credit, then borrow out $500K, pay the debts off, get the cash flow. I'm going to use these same numbers. I'm going to illustrate what it would look like if instead of just making a normal repayment of $15K right back to the policy, what if we used all of the person's income to illustrate the repayment? So then it's technically what's happening is we're paying more without necessarily trying to pay more or trying to cash flow more. It's just whatever happens each and every month. This, I believe, because this person has fluctuating income, they can have high months, low months, whatever it may be. Well, I want to take advantage of that by having the line of credit and without having the challenge of committing to a payment amount, 15K, 20K, whatever it is. What if we just drive all the income right into the line of credit itself? Could that speed up the payoff? And does that result in a lesser interest cost? So let's run the math. Let's say 500K, and we're going to minus income, 35,000. Now I'm going to round down just to make the numbers look a little more simpler. So you round down 35K, balance started at 500,000, but only for one day. Let's say it was at 500K. And throughout the month, or let's just say all at once, I plop in my income, $35,000. And now expenses are going to come out, say 22,800. So at the end of the first month, we're at 487,800 versus what happened with the policy loan. Let's say they made the $15,000 payment. They're at 485. So the only discrepancy here is if we want to keep the numbers the same. So I'll probably change this a little bit. The cash flow technically needs to be the same. This person has to cash flow a little more than what we're illustrating. Prior to this loan being paid off, in this expense number here, 10,000 was already being accounted for as a loan repayment. All right, so that's where they're seeing their ability to do anywhere from 15 to 20,000. So let me finesse the numbers over here to illustrate a cash flow of 15,000. All right, saying the same cash flow amount. So I'll do expenses of 20 instead. So let's do that so that we're not confusing ourselves. Comparing the strategies here. So you do 20,000 of expenses. So 480, right, is what it would come out to. Yeah, so 500,000 minus 35K, 465, and then add 20K. We're at 485. Boom. Yeah, so that's the final 485. That's what I was trying to illustrate. And we do the same thing. Do 45 times 5.75% and divide by 12, divide by 30 days. So that's 77 bucks. Do the same thing here. $74 a day. And we'll estimate 500 grand was owed for about 10 days. So we're doing 10 days, 10 days, 10 days, total of 30 days of showing what a line of credit could look like when you're parking all the income into the line, taking money out to pay expenses, pay bills, and then all of your cash flow stays in the line of credit, reducing your interest costs. So this is an overestimated way to, by hand, calculate interest and see what you get. 80 bucks. So 80 plus 77 plus 74, 231, divide by 3. Our average cost of interest, $77.28 per day. Times 30 days. Look what happened. $2,318.60. Same money, a couple dollars less than the interest I'll pay back to the insurance carrier. Do you follow me? Let me know in the comments if you followed me there or if you need me to do it again. What I just illustrated was the same money or same cash flow, just being driven in a different direction. Simple infinite banking by itself is you borrow money, you pay off the debts that you're trying to pay off, you then repay yourself back. Whatever interest you pay will get tallied up, and then you'll pay it one time per year on the anniversary date. Obviously, with the goal of, the faster I make payments, the lower the interest costs will be. We estimated in month 1, you'll pay $2,328. Month 1 of velocity banking and infinite banking together, infinite banking being the tool, which is the cash value. We go to a bank, we get a line of credit from them at an interest rate that arguably in this current economy will be less than the loan interest rate from the carrier. So there's already a technical win there. Even if I had the math the same, even if the rate was the same, I can still argue the fact that because I'm using all of my income and parking and driving into line of credit, the net interest cost ends up being $2,318.60. So 2,328 minus 2,318, about a $9 difference. About a $9.40 difference. Doesn't seem like a lot, but do that over the same amount of time, then we're not done. You got to inject the other things that you get with velocity, which is Credit cards. If this person runs their expenses through a credit card first and gets anywhere from 2 to 3% in cashback rewards, that means however much money they ran on the card, say it was $7,000 of expenses, they run that on the card, they get 2.5% cash back is $175. And when the credit card is due, because that bought them about a whole cycle, 28 days, almost 30 days, bought them a cycle before they had to pull money out of the line of credit, which means more days my balance was on the lower end than closer to the higher end of 500, which would bring that number down, which would increase this number on a monthly basis. And then you add the cashback rewards as a credit back to your expenses, and you're technically reducing your operational expenses every single month, which means more cash flow, so 175 more stood in the line of credit. That is an extra 2 cents, almost 3 cents per day that you're saving. Again, these numbers don't seem like a lot, but can absolutely add, or I should say reduce, a few more months than this illustrated timeline that I have here. The other variable that comes into play is the flexibility of cash flows each month. Are we confident that this person is going to be able to make a $15,000 or $20,000 repayment to their policy loan each and every month with no hiccups? Maybe, maybe not. When that doesn't happen, let's say for 1 month, this is where velocity gets the upper hand. Because when there's a shortage in cash flow, at least I had all my income driven into the line, and I technically reduced my balance for a certain amount of days more than waiting for confirmation of cash flow to make that $15,000 or $20,000 repayment back to the loan. Let me say this, both options are amazing. Both options are amazing. But when you combine them together, I believe you can get an even better result. And the simple fact that when you combine them together, I think it's even easier to process. It's even faster. When we go to make a loan payment, it does take a couple days for that to process, for the Guardian life insurance carrier to process that payment. So that's an extra couple more days that you're getting charged interest until that payment gets processed. In a line of credit, it's instant. By 12 o'clock midnight, if all my income is sitting in the line of credit, calculates, midnight strikes, I get charged interest based off of the final balance of that day. I also would argue there's more flexibility here. So pros, this is what gives the upper hand. This is so absolutely is a strong prerequisite for life policy, 100%. And they're not sending anything to investing in their life. They're not increasing their skills. They're not starting that business, and or they're not investing in any kind of retirement account at all. To me, that's an imbalance. Personally, that's an imbalance. I have personally like to save 40% of my income. This is what I do. I like to try and save 40% of my income. And that 40% of my income flows into whole life policies. That's what I like to do. So 40% of your income versus 40% of your cash flows, two different numbers, or can be two different numbers. Let's just say, for the sake of this metric of $18,000 of cash flow, when deciding if I'm ready to fund a life insurance contract, like, take this person for example, bring in 35 grand a month, and prior to starting the whole life, their cash flow's much higher than 13 grand. They allocated 25,000 to the base with the ability to do 200. Within their expenses alone is accounting for the premium of $2,500. So if we did 2,500 plus 13 grand, cash flow is more like 15,500 times 12 is 186,000 times 40%, 74 grand. So they could set the max to 75,000, right? Let's say they did that, and they structured a premium of somewhere around 7,000, 7,500 bucks. So this is where you get to kind of set your own framework here. I just know back then, because I'm showing lesser cash flow, and again, like, of these expenses, 10,000 is literally paying back the loan. So it's like 10 plus 25 plus 13. There's a lot of cash flow to work here. So that's why they not only created that extra mech space because of their high cash flows, but also when they buy and sell big investments and they have a lump sum of money to work with, they want to have the ability to just park a bunch of money in. And the first time in a few years, we're in that environment right now. So they perfectly designed a policy for their situation. This is more of like a baseline framework here, where I say, look, I either save 40% of my money towards whole life insurance, or I take cash flow, $1,500 a month, conservative, times 12 is 18,000 per year. And just like velocity banking, if that's my capital to work with in a year, max leverage, 2/3, 11,880. In this example, I wouldn't fund a policy for more than 12,000 per year as my max. In this example, 12,000 per year being a max, that's basically saving $1,000 a month. Keyword saving. So anytime I'm working with someone, as long as they are saving money already, or they have capital set aside in cash, high yield savings, money market, CDs, wherever, they have capital set aside, and you have first year's funding available. So, a lot of parameters here. I think it's important. I have had, literally, I can count on my hands the amount of policies that have been surrendered in my 8-year career. And I think it's because I don't overhype this, number one. And number two, I just set parameters in advance. Now, if I have a client that goes and gets a policy with someone else, I don't count that as a client for me. Even though I'm coaching them, if they already have whole life, or they went and got whole life with another agent and they settled on a number prior to speaking to me, and then that policy lapsed or surrendered, I don't count that to my record. Just saying. I don't do that, because that doesn't make sense. I'm talking policies that I've personally been a part of, that I personally put together and helped that client through. I can count on my hands the amount of times policies have surrendered, lapsed, they gave it up, they stopped doing it, in that sense, in 8 years. and I've been a part of a lot of policies. So again, let's go through it. Educated, cash flow, monthly, $1,500 per month minimum or more, conservative and consistent. You either are saving a percentage of your income. If I had to put a minimum, because 40% is a lot, don't get me wrong, that's just me. Minimum 10%. As long as someone is saving at least 10% of their income, upwards of 30%, they have a track record of saving money, and they have a savings account or emergency fund, so they have some capital set aside. And if it's $12,000 per year, let's say that's the number that you want to fund into a whole life, $12,000 per year, that you already have it in your savings account at the bank, liquid and available. First year you already have available. That's when I, Denzel, feel comfortable being like having my name on the policy. If I don't feel comfortable, then I don't put my name on the policy. I'm like, no. Now, if they're like pushing me in a way, like I really want to do this, yada, yada, I'm like, look, that's when I will bring up a company like Guardian, where I say, okay, say 12,000 is the max. What is a number that you can fund with your eyes closed each year, and it would be no skin off your back, it would no pressure whatsoever? And they'll say something like, I know I can do $4,000. I know I can do $6,000 per year. That's $500 a month. So I know I can do this minimum. That's what we set our base to. And then whatever the max is the difference, is the flexibility, right? I'm not committing myself to 12,000. I'm not committing myself to 200 grand. I'm committing myself to a lower number, typically 10% of whatever the max is. So if it's 12,000, then the minimum might be like 1,200, 1,500, $2,000, something like that. That I know, okay, day one, boom, they can at least fund that, and then they'll add money throughout the year. So I set that as a parameter. I think that's super important. Whoever you're working with right now, an insurance agent, or you choose to decide to work with me, that's what I'm going to share with you. Because I want these things to work, period. I want it to work. Not only work, I want it to work when life happens. How often does life happen, ladies and gentlemen? Life happens every year, every month, every day, every week, every holiday. Am I right? Life happens. So when you're putting together a financial plan with someone and you're going off of your best case scenario numbers, you're not underestimating cash flow, you're not underestimating income, you're not overestimating on expenses, you're not building in buffers, and especially you're not factoring in life. How can any financial plan ever succeed? It just, on paper, it looks great. On the whiteboard, it looks great. On the spreadsheet, it looks great, but it failed. What if this gentleman committed himself to a bill of 200 grand? And let's say he did it in the first year and he did it in the second year, but then something happened to real estate and he couldn't do it in year 3. So now we have to alter the policy internally, dropping down the funding, and that can mess up the whole policy's original illustration and projections. It can mess up the whole thing. So what I like to do is you build in that flexibility. Say, hey, I know you want to do 200 grand. I know you want to do 12 grand. I know you want to do 20 grand. I know you want to do 40 grand. But what's a number we know we can do that would not interrupt the internal design of the policy and gives you that freedom to add more money at will, at leisure, whenever you want? What does that look like to you? We find that number. And as we're planning, I'm educating the client, okay, if you're not already saving money, begin to set money aside for this asset. So on the anniversary date, you have first years fully funded. So that if all hell breaks loose by year 2, we have multiple options that we could tap into. We can change the annual funding amount, switch it to monthly payments. We can borrow against the cash value to pay premiums to keep the policy from lapsing and surrendering. So all of those things I think about, I process that you're not thinking about because it's your blind sides. Remember, you're not in it like I am. I'm in this day in, day out. Hundreds of case studies, so you get the full advantage of leveraging what I love, and you get to receive it. And now you've got 360 view of everything that's potentially can come at you as you're putting together your financial plan for success. And with that, we're all done. We're all done. Monique says amen on coaching and accountability. Have to tap off. Yep. Appreciate your time, Monique. Shout out to everyone on Zoom. We got Jacqueline in the house, and Abdul, and Darren, and Rachel, Miss Davis, and James, and Paulie, and Carlos. Love seeing some of these names that I haven't spoke to in a while, so this is just me calling you out. Like, hey, get on my calendar, especially if you're a lifetime client, especially if you've invested in coaching. Get on my calendar. Let's have a call. Let me see how you're doing. Let me see how you're operating. Even if you don't have the best news to share. Remember, Denzel thrives in chaos. Like that's where has always been my specialty. Is working with people in the mud of whatever mess you're dealing with. That is where I thrive. And then when you have success, then it's just accountability. Holding you accountable, preventing you from falling back in the mud, preventing you from digging a bigger hole. Accountability, accountability, accountability. Then you get to a place where you get so smart, you're smarter than me, and then you stop booking calls. When you stop doing that, then what happens? Life happens. And when you don't have a partner, a financial professional to support you along the way, you start making decisions that's not in alignment with who you are. Start doing desperate moves. Start making desperate moves with your money. Now you're back in the dirt, but you're not that far in the dirt yet because you still haven't booked a call. But for whatever reason, you let that dirt pile build up so bad that you've got no choice but to call Denzel. And then when you call Denzel, what do I say? How you doing? How are you? I love you. I miss you. I appreciate you getting reacquainted with me. I hold no judgment on you. I will not beat you up. I will not call you out. I just simply have you share your story. Tell me what's going on. How do we move forward from here? How do I get you on a path to success again? Let's recover. Let's learn from our mistakes. We keep going from there. Gemma says, how do I book a call? Okay, so for those who are not a client or you've never had a phone call with me before, let me send you my calendar. I have it live on the YouTube link in the chat. So I have it there. And we're going to drop it in the Zoom for everyone to book a consultation. If you are a client, don't remember, send me an email so I can look at our history together and I'll help you, especially if you're like in one of my courses. I do a bunch of free calls a lot, especially for those who have like been following me for years. You bought a course back then, you did something with me in the past and you just forgot. You're like, hey, can you look me up? That's my email right there. That will come directly to me. Never done any work with me before, you can book a consultation. We begin that relationship from there and see how we can work together, see if there's alignment, where I can fit in, how I can serve you best. All right, so we're going to go ahead and close out for the evening, respecting everyone's time. Thank you again. God bless you all. And we'll be talking soon. All right. Bye now. Thank you.